This is Only the Strong Survive, a podcast powered by Kahn Media, where we dive deep into the world of business, leadership, and innovation. I'm your host, Dan Kahn, and I'm honored to have you join us today. So, let's get ready to learn some survival skills together. Hey, everybody, and welcome to a new episode of Only the Strong Survive. We don't normally kind of tee up these episodes with standalone intros, but we are doing something a little bit different, and I thought it was worth having a few minutes to kind of explain what we're trying to accomplish. OTSS is really focused on entrepreneurship, leadership, and everything in the business development cycle, from ideation and starting your own business to running a company, growing it, scaling it, and eventually maybe even selling it, which is, that exit is something that some people do think about. One of the things that I've been introduced to over my career is private equity. And, financial services come in all shapes and sizes, especially people in the tech industry are very well familiar with all sorts of different types of investors, angel investors who will come in with a kind of an early investment and then they kind of stand back and let you run your business, or venture capital firms that will come along and write a check to help you scale and grow your business, looking to essentially own a piece of it. Private equity is a little bit different. And in the businesses that I have been involved in over my career, PE has been there and played a role almost from the beginning. Our listeners will know that one of my early jobs in my career is I worked for a big publishing company called Peterson Publishing. It was originally started and run for many decades by a gentleman named Robert E. Peterson. He eventually wanted to retire. His sons, unfortunately, had passed away in an accident. He had no family to leave the business to, so he sold it at a $400 million exit in the late 90s. And that at the time was a big number. That was a big deal for a publishing company. Well, the company he sold it to was another media group. They cut some jobs and jacked up the ad rates and made it very profitable. And they flipped it at a substantial profit. I think it was close to or even over $1 billion to a private equity group that also did the same thing. They bought a couple of other publishing companies, merged them together. That's called a tuck-in. They kind of made a much bigger enterprise by merging a bunch of competitive companies. They eliminate any kind of overlap. And then they sold that to another private equity company, and so on and so forth. And over the course of about a 10 or 15 year period and about 3 flips, it ended up selling to Discovery Communications for several $1 billion. And since then, that company has experienced some challenges. So that was really my first real job. And it was my first experience. I lived through a couple of those flips and eventually decided to leave and kind of went down my own career path. But since then, running both Kahn Media and Tread Agency, we have also had a variety of clients. We've had clients that were founder-led that sold to PE, and we stayed with them through 1 or 2, or even in one case, 3 flips. We've been brought in by private equity companies to either solve problems, fix broken systems, or to help rebuild reputations or just crank up brand awareness. We've also been involved occasionally in a company that's private equity owned that kind of comes through the other side and ends up going through an IPO and becoming public. So it is something we're quite familiar with. I'd say even today, more than half of our clients are private equity owned. And look, like anything in business, there are great businesses and there are challenging businesses, and there's great people and there's less than great people. And so I do think that, private equity is a nuanced thing, and in both automotive and also the outdoor recreation industry, the two kind of industries we serve, PE has sort of a mixed reputation. There are some people, especially business founders, that are looking for an exit or that just sort of hit the wall and they can only grow and scale their business so quickly, and they kind of are at the limits of their own skill set, that see it as a huge opportunity to grow and scale and build a much bigger business, build more wealth, or even just retire and walk away with a check. It's good for that. There are certainly a lot of stories floating around out there about things in private equity that maybe have not gone so well. We wanted to sort of explore that concept and really get in deep. And it's a hard thing to tackle on a podcast. And surprisingly, actually, as Katie, our producer, and I have worked on this, it was surprisingly challenging getting people to come on. And I think there's like a sort of a veil of secrecy around this segment of the industry, partly because they are kind of quiet and they're very, very profitable in most cases, so they don't like talking about that publicly. There's also some SEC regulation here in this country about how they can raise money, and I think they're a little bit nervous about compliance. Just trying to get people to come on and talk about it was way harder than I thought it would be. So what we ended up doing is we've recorded 2 episodes. This is going to be a 2-episode, kind of 2-part series. What you're about to listen to is part 1. And part 1, we really wanted to sort of tell the story of kind of what PE is and how it can work, how it can be beneficial, wonderful. So our first episode is with Alex Rawlings. He is actually the host of the Private Equity Podcast. He's based in the UK, as you'll hear. He also has his own search firm where he does executive recruitment exclusively for the PE industry. So he works with a lot of major PE companies. He works with a lot of executives in that industry. He interviews them regularly for his own show. So he is a subject matter expert. We were grateful for Alex that he gave us his time, and he gave us a really great sort of expert, but also neutral observational view of that industry that maybe we wouldn't have been able to get from someone who's internal at a private equity firm right now, because they are constrained by some of those SEC rules that I talked about. So this was a great first episode to kind of explain, here's all the positives and all the benefits of this, and kind of get into that. And then we will have a second part of this episode that will kind of examine maybe some of the more challenging aspects of private equity, and that'll come next. So I hope you enjoy the episode, and I appreciate you kind of going on this ride with us. And again, thanks to Alex for shedding some light on this really interesting topic. Welcome back to Only the Strong Survive. I'm your host, Dan Kahn, and today I'm joined by Alex Rawlings, host of the Private Equity Podcast and founder of Raw Selection, a private equity executive search firm. Alex brings a wealth of knowledge about the private equity industry. He's had some of the top minds in PE on his own show, and we're really excited to dive into both the basics of private equity and even the intricacies of how that industry works, how recruiting in that industry works, and what business owners should look for when they're kind of considering PE. So Alex, thanks for joining us, and appreciate your time today.
My absolute pleasure. Thanks for having me on.
So I guess just to start, for color and context, we work with, in our other business, we work with a fair amount of private equity owned companies and have kind of gone through that process over the years and even worked with a lot of founders as they've sold. And I've seen sort of a lot of positives and I've seen some challenges. And so it is sort of a nuanced conversation. And we really wanted to have someone on who understands the sort of intricacies of that industry and how it functions. And I've listened to your podcast quite a bit, and the Private Equity Podcast, for anyone who hasn't heard of it, is great and available on all the platforms. So I encourage you to listen. So Alex, can you give us a little bit of your background, how you kind of got involved in all this, both the podcast side and also tell us about your actual, your day job?
Yeah. So podcasting, we built purely on a brand building exercise. It's a very good way of getting your firm out there, obviously running an executive search firm. So we wanted to connect with as many people in private equity as we possibly could. And we wanted to have contact and communication with people that reaching out and going, basically, do you have a search that you can work on? It's a little bit warmer when you reach out to them and say, would you like to come on our podcast? And so that was the generation and build upon that. We were happy with 100 downloads, if I'm going to be honest, per episode. I don't know what we're on now. I think we're on average is about 2,500, 3,000 per episode. So it's gone really well. And you just focus around the value side to bring value to the audience. With regards to the actual business side, the podcast isn't a revenue play for us, but it's executive search. And as you mentioned, we focus exclusively on the private equity industry. We work with their platform acquisitions or portfolio companies. There's lots and lots of jargon in private equity, as there is in any level of business. There's 1,000 different words for just revenue, sales, and everything else. We focus on working on that. We do a lot of work in the US and a considerable amount of work here in Europe, but most of our business is actually stateside, and we support their private equity firms with hiring their investors and the people that will do due diligence on companies, the people that will raise capital for those private equity firms, and the people that will support with what they would call value creation within the portfolio companies. And then, of course, we put their C-suite executives into their portfolio companies. So we get a really nice general blend over the full landscape of private equity, how that runs and what happens. And we've been doing that now for in 2024, if you're listening to this post, obviously this year going out. So we've been doing that for the last 7 years as Raw Selection.
And looking at your CV, it looks like you've been in recruiting and search for a long time, but it looks like maybe private equity is a newer thing. It hasn't been your whole career. When did you decide on that specialty and how did that happen?
So that started, in essence, when I set up the firm. The majority of my career, I'd done just general industrial appointments from salespeople through to vice presidents. I'd started to get a flavor for doing more C-suite appointments and running with that. And I wanted to do that. And that's what I was passionate about. I wanted to work at the top of the industry, and I wanted to place the individuals at, the top movers and shakers, so to speak. So I did a lot of research, looked at who owned companies, and found the private equity industry. Private equity is not well documented. It's very well hidden. It appears very cloak and dagger. We struggle to get people on our podcast. You'll notice there's a typical trend that we do a lot in the lower middle market type businesses, but the big boys don't like to come on podcasts. They're not allowed. So it can be hard to really understand things. So, I just dive straight feet in, like anybody would, and decided to build a business in a space that I hadn't operated in and I didn't know particularly well. So I had to learn things from the ground up. And I wouldn't say there's a lot I learn every day, but there's still bits of snippets and pieces that I still get an insight into what's going on in private equity and what happens. But, certainly from a fundamentals of what the industry does, it's been very, similar for the last 20, 30 years, and with some of the big boys coming in. And what's impressive about this industry is the amount of wealth creation that it's created. In that financial services has created more millionaires than any other industry. Private equity has created more millionaires than any other industry within financial services. So it's a hell of a growing space. There's a lot of capital in it. It's also getting fiercely competitive and has done over the last 10 years, as really opening the gates with regards to different firms setting up. And if you look at companies like Blackstone, the owners of Carlyle Group and Blackstone and two of the KKRs are still with us. So these guys have built these levels of billions of dollars assets under management within a lifetime. So you can see how much that industry's grown and what's happened with it. And, it's produced some absolute phenomenal businesses on top of that as well as some absolute horror stories.
So, it's interesting. You made a comment earlier about kind of your own show and getting guests. And that is something I wanted to touch on. It's interesting that, like you, I started my podcast, and I had a podcast a long time ago in like 08, 09, early days when it was hard to even get the content. Loved it. It was too much work. Had other things going on with my day job. Walked away from it, came back. Similar to you, I want to tell stories. I want to interview interesting people, but it's also a good lead gen tool, and that's cool. For the most part, I have found that we've had a variety of different topics we've covered on the show. If you call a business leader and say, hey, I think you have a really great story and I want to learn more about your model or your business or your story, can you come on and talk to us? Most of them, generally, if they have the time, are eager to do so. That has not been the case with PE. It's really interesting, like getting someone to even come on. And I was so grateful that you were able to come on because you do this all day, every day on your show. So you have a lot of insight into that industry. But you're right. The bigger private equity groups, why do you think that there is this sort of like dark side of the force thing where they don't want to acknowledge that they exist? They don't want to do media. They don't do press. They don't do interviews. Why is that, you think?
So there is a big publication side of private equity. If you look at like Steven Schwartzman, David Rubenstein, these guys are talking about private equity a lot, but they're more talking about who they rub shoulders with and what's going to happen with the markets and things like that. The big reason that restricts private equity is basically you're not allowed to sell private equity. The regulations and conduct authority prevent firms from going out there and going, we're raising capital. You're not allowed to do that. And there is a lot of red tape and stringent nature around this alternative asset class that prevents people from going in and going, guys, we're raising funds, we're selling this, we're doing that, we're going to do this. And a lot of it's hidden behind press releases of we acquired this business, we sold this business. You won't see a press release saying these guys are doing this is what they want to do, this is how much they're going to raise. Rarely you'll see elements like that. You'll see bits published, but not a huge amount. And there's just a big fear that someone will say something wrong. A lot of our private equity guests that come on get recordings of the show, and they then goes off to compliance, and that gets checked that they haven't said. We've had things removed when people have mentioned that they get capital from this LP. An LP is a limited partner, and they'll say, you can't have that going live.
So in this country, is that like the SEC? Who's regulating that? It's like, I assume it's some sort of like, and I don't know about in the UK, but in the US, I assume it's some sort of federal oversight. Is that what it is? Or is it internal oversight?
Yeah. This is governmental regulated. So I actually don't know the US, probably the SEC, I would have thought, or something like that. But yeah, financial conduct authorities for the UK. But yeah, it's heavily regulated, same in Europe as it is in the US. And there's just lots of stringent nature on it. And therefore people fear going out and having those conversations. Plus it's just financial services. Law firms are a bit the same. They're all a bit, we don't want to do this, we don't want to do that, we don't want to kind of break any eggs. But we're starting to see more personal brands coming out of private equity. We're starting to see more companies doing things to disrupt things. I've just had somebody on, his name's going to escape me, but who's actually a private equity investor who now runs his own YouTube channel, who talks about some of the deals that he's done where he's allowed, but he also talks about, what Elon Musk is doing and what's happening within markets. So there's more and more starting to happen as people begin. And I think there's an element of, the regulation being a little bit of a cop-out for people, but there's also an element where that is a genuine concern for a lot of companies, and nobody wants to get caught out and be promoting their fundraise when they're not allowed, because it comes from institutional capital, which if you've got a pension you may pay into private equity. I'm pretty sure everyone listening's got some kind of insurance policy. Well, these guys have to sit on loads of cash, because when you bang your knee or trip over in the street or whatever happens, then you're going for your lawsuit and you want a lot of money. Well, they'll have invested that capital to sit in private equity on depending on cycles, but 4 to 7 year cycles of invested capital. So there's lots that go into that, but it can be a very closed environment. But That is changing. Firms are wanting to do what they call deal origination, which is basically sell to founders and owners of companies to sell their company to them. So they have to become better known. So you're starting to get emails from private equity firms. They're not just going through the traditional route of an investment bank or an M&A house or a broker. They're starting to do things directly. So we're starting to see a little bit of, private equity starting to come out in the hood. And, if you think about what private equity has created, if you think about the GE Corporation and all the wealth and revenue that business created, well, in essence, the big boys of Carlyle, Warburg, KKR, who are some of the biggest, Vista, probably not the biggest, but one of the most successful. All these businesses have come out and they've basically stripped GE of all their different denominations of companies and created these monster organizations with 40, 50 portfolio companies under their banner. And they are diversified from, one is in healthcare, one is in manufacturing, one's in financial services. There's no clear link to any of these businesses. In the most part, Vista Equity Partners are specialists in software. Their returns have been incredible. But in the most part, those firms have just acquired loads of different businesses. They've taken companies out of the likes of GE. They've taken founder-owned businesses. They've taken publicly listed businesses and made them private. And they've created these big powerhouses of companies. And they've driven value creation into those businesses. Now, there is times when they've got it wrong. Toys R Us was a KKR-backed business. That went horribly wrong and obviously went under. I think there's a little bit of Toys R Us starting to come back. I've seen, certainly in the UK, we're starting to see that. But there's been some bad moves. But in the most part, they've done some phenomenal growth stories of organizations. And some of these businesses have created huge returns. The biggest one I know of is a 300 times return on a portfolio acquisition. So if, for simplistic basis, if they acquired that business for 10 million, they've produced a 300 times return on that 10. So, and that will be small. They won't have done 10 million. The business, I won't say what it is because it's confidential. Of course it is, it's private equity. That kind of level of return, they're not doing 10 million check sizes. Again, I'll use terminology. Check size is how much money they invest into your business.
Do you think part of the reason they keep things close to the vest is because, unlike in a publicly traded company, there's a lot of disclosure. It's all very transparent. Do you think part of the reason things are sort of quiet on the PE side is because they are so successful, that they're making so much money and that they are driving so much value that it's sort of the, is it gauche, or do they not want to share that?
I don't think that's the case, because if a private equity firm does an exit, they put out a public post that says, we have sold our stake in this business, providing it went well. If they didn't, they just ignore the fact and you never hear about it. They'll sing when they win. As the knowledge and content age is now very much upon us, and we've gone from not knowing enough to now having too much knowledge and too much information. And there's a fantastic podcast, depending on your position on it, but the Diary of a CEO podcast was really accelerated really fast, the take up on that. And now he's interviewing people and going, calorie counting's a myth. And then the next guy comes on and goes, calorie counting's essential. We get that complexity around it of, well, I don't know what to listen to now, and there's too much content, there's too much information. To bring that back to your question, I just think private equity, I don't think there's been a huge amount of interest in who owns a company. I don't think anyone's really that bothered about, it's a bit like stocks and shares, really. We're only interested in who owns Twitter because Elon Musk has bought it. If someone said, well, who owned Twitter before that? We'd have gone, well, I've no idea. The reason we know who owns a soccer or a NFL team is because somebody famous has acquired them. And I just don't think the general public had any interest in who owned who unless they had a real public entity around them. Now, you'd be far pressed. I mean, Warren Buffett will not like me saying, he won't care what I say. I'm nothing to Warren Buffett, but Warren Buffett wouldn't like me saying that he deploys a strategy of private equity. And everyone would go, well, okay, I know who Warren Buffett is. Most people are like, yeah. But if you said, who does Warren Buffett own? You'd be like, well, I know he owns Coca-Cola. I know he owns Apple, after saying he wouldn't own Apple for a long time. But if I said, who owns GE? Well, it's publicly listed, but who's the biggest GE stockholder? Nobody would know because somebody famous doesn't own that business in the most part. So, and I have no idea. But I think that's probably where private equity is. It's just not known because it's not been publicized enough, because private equity firms aren't running around going, we own a division of Diageo, and the general public go, we don't care. We just like buying X toothpaste or B products. I don't care who owns it, and I don't care what you're going to do with it. I think that's probably where that sits. And I think as general industry, but if you look at financial service industry and you say private equity, to anybody in that industry, they'd go, oh yeah, I understand what private equity does. They do this and this. Whereas most people are like, I don't understand that. But that's because it's at ownership level. And if someone said, what does private equity do? They buy businesses and they sell businesses. And it's a bit like saying, well, would you know who the most successful broker is of companies? The answer to that question is probably going to be no. Because if you haven't sold a company, you've got no interest in finding that information out. So I don't think it's necessarily private equity's fault. I think what they've done poorly is they've poorly promoted themselves to the market, to business owners, which is what they're now trying to do as what they will call proprietary deal flow, which is what we would term as you don't pay a fee for introducing that business, whereas an investment banker or broker would charge them a fee and probably you a fee for the introduction.
Yeah. They need better PR. Yeah, well said. So let's dive into something you just said, because I'm operating under the assumption that most people listening know what PE is. So let's go back a step and just, because you're right, it's buying and selling businesses, but it's more nuanced than that. So can you break down a little bit how that model works? Because I think one thing that's sort of interesting is that Buffett and Berkshire, for the most part, they do the buying part. They don't seem to do a lot of selling. So it seems like they're sort of a buy and hold kind of organization for the most part. This could be from the, Blackstones all the way to the small and mid-market guys. What is the basic business model for a private equity group?
So if a lot of the listeners here are founders of businesses, owners of businesses, let's start with what we call the lower middle market. Now, the lower middle market basically buys smaller companies than all of the private equity firms that, if you Google private equity, we actually did a blog on it, and it's one of our most successful blogs, which is useless from our industry perspective, but it's useful for this context. Why we're training people on who the biggest private equity firms when we're in private equity is pointless, but it did well. If you say who the biggest 5 private equity investors and, all the Carlyle groups and everyone will come up. But if we look at the businesses you probably haven't heard of because they've not marketed themselves well enough to you, those are the businesses that would acquire founder-owned businesses, depending on revenue sizes, etc. Let's look at the cycle. So we've already understood that private equity firms will raise money. So in the most part, private equity firms don't spend their own capital. They will spend some of their own money. So what's called a GP, which is general partner, probably not hugely important for this context, but those are the people that are doing the due diligence and running the private equity firms will put a bit of their capital in. So once they've raised capital, they'll then go to market to deploy capital. And when they say deploy capital, they want to buy X or Y or Z business. So they will go out there to buy that organization. I won't go into detail with regards to what they call LBOs and leverage buyout models, but in their structure of how they finance things. But it's not the business is worth X, they pay X. The business is worth X, they will pay a certain proportion of that, and some of that will be debt in the most part. The best way of explaining it is if you ever mortgaged a house, they do exactly the same, but instead of them paying the mortgage off, the business does in the most part. So they'll go through usual due diligence phases, go through everything that they want to go through, and then obviously if you all come to a number, multiple of EBITDA, enterprise value, whatever you want to call it, they'll then make the acquisition. Post the acquisition, they're then typically looking for a whole period of 5 years. Some's 3. If they're very fortunate, most is 7, but they'll all claim to be a 5-year hold. I haven't met a private equity firm yet that goes, yeah, we're going for 7 years. They're all going for 5. They'd all like to do it in 3. The difference between, a typical sale, if me or you are out there to go and buy a business that's very similar to ours, we will acquire that business, mold it into ours, and probably the owner will maybe stay on for 3-6 months and then disappear. The private equity firm may do that and you'll move into a chairman role or something of that nature, but you're going to try and make your money on the second sale rather than your sale. So when you go to private equity, you tend not to make your big bucks on your first sale. You tend to get your better one on your second. Obviously, they're going to take a business from, let's say your business is 20 million. Their goal will be to move that to 100 million is usually typical. You're like, okay, well, it's taken me 30 years to get this business to 20. Well, how the hell are you going to get it to 100 million in 3, 5, or 7 years? Well, private equity firms aren't very good at doing organic growth. They will hate me for saying that, but typically they're not. Private equity firms are very good at doing what they call roll-ups, or just basically going out and acquiring your competitors and similar companies, rolling the back office systems into it, increasing the EBITDA on the basis of it, and then scaling that business on the front end. There's plenty of firms that have done incredible stuff on organic growth. And I know businesses that have tripled and quadrupled businesses without any acquisitions, but typically that's what they'll go after in order to grow the business. They'll get that to 100 million and then they'll take that to a liquidity event. Now, typically private equity businesses, they'll talk about 2 exit events. One is strategic, which is just a corporate business or another owner. And then the second is another private equity sale for them then to go again. And they'll look at obviously those different models. So literally when I say private equity has some of the smartest people in any industry, both as operators and investors, and operators are people who are running these companies, that's why it is, because most companies are not going through that level of growth. They're just not going to basically 5x their revenue in 5 years. And private equity industry is just absolutely built on it.
Well said. Thank you. And that really reflects my personal experience, where I have a small handful of friends that started in private business. In a couple of cases, went through an acquisition and somehow ended up as operating partners in kind of mid-cap PE firms. And in both those cases, they're two of the smartest people I know. Like, these are brilliant people that have ended up kind of on the PE side of the table, and they're very bright. You know, I've been kind of ringside to both, right? I've seen what can happen when, including my father's business, where he was struggling and at the end of his career arc, and a group came in and bought his business and scaled it like crazy. I mean, end of year one after the sale, they had 5x'd his business. It was really impressive. So I've seen how that can work. I've also seen versions of the Toys R Us thing, which is not great. So I'd like to dive in a little bit, because I think you're right. You know, I think most small and mid-sized businesses usually exist because someone identified a problem that needed solving. And then the founder says, okay, let's figure out whether it's a service business or manufacturing business. Like, hey, somebody wants something or has an issue or a challenge. And, you know, let's figure out a way to solve it, whether it's in a community or global, whatever it is. And they usually are kind of living with their customers, right? They know their customers and they're living in that world. And it doesn't seem like that's where PE wants to be. They want to have exponential growth through kind of, like you said, like roll-ups. So what is, in your experience, how does that usually work? Is that where they, you know, do they look for sort of a big business to be sort of the keystone and then they build around that? You know, how do they usually kind of approach those sorts of scenarios?
So private equity will communicate it, they have like a platform, their main platform acquisition, usually their first acquisition. And then they'll look to do what they call add-on, tuck-in acquisitions on the back of that. They'll look at similar and direct competing type businesses to do that. Integration and acquisition is particularly hard. To merge cultures together, to merge operating systems. We're not talking, 3-6 months and we're all going. Some of these things can take years to properly integrate. And there'll be guys out there saying, yeah, it shouldn't take years. And they're right, but they do. You know, there's plenty of acquisitions that never actually get rolled in together and still operate independently. They will get 20 million revenue business and they'll look at larger. I know one at the moment that's basically got a platform that's I think it's about 20 million and they're about to acquire a business that's 30 million. The reverse size acquisition, it doesn't matter what size they are to integrate that into it. I think the challenge that comes for a lot of owners and founders of businesses is that sounds great and what an exciting ride, and absolutely so. What I don't see a lot of is owners and founders of businesses going along for that ride. They will transition to chairman roles pretty fast, because what's got you to 20 million certainly will not get you to 100 million. They will bring in executives that will do that. You know, private equity gets a bad rap for this kind of context, but they're not there to teach you how to do this. They're there to get the business there. And that's fine because that's their business model. And they aren't going in and going, oh, yeah, we'll support you. We'll teach you how to be a really good chief exec of a £100 million business. You know, we've seen Gymshark is a really good example. Again, a UK business, but obviously international now, backed by a very famous firm called General Atlantic. They keep themselves very heavily under the radar, in my opinion, but very successful firm. And that guy grew that business from scratch. He's still with it. And he's moved down out of the chief exec role, then moved back into it. I think he moved out of it again and then back into it again because he had to take a different role to begin to get the development to get to where he wanted to be. And also you've got to consider that, you know, if you look at the guys that have whatever capital you call, if you're going to give away part of your business, you're going to lose control. And a lot of these firms will want majority control because if you start making stupid decisions, they will stop you doing that. Or if you start going down the path they don't think is right, they may be wrong and you may be right, but at the end of the day, they want their decision. They've put X amount of money into the business and want to drive it. There is minority shareholders. There'll be firms that will take a minority stake, a bit like a stocks and shares type model in similarity. You know, in the most part, they'll take a majority share position and they will go out there. They'll do the due diligence, they'll support you with the origination, and they will basically add on as many companies as they can to get to that target number. And they don't usually focus around revenue numbers, they focus around EBITDA numbers, get the EBITDA to a certain level, then work on the value creation side of how do they optimize the business to make it. So most industries have a exit multiple or exit multiplier. So you know, software, if it's 11, 15, whatever it would be from there of EBITDA, so 11 times your EBITDA at 10 million to sell, they'll try and get it at the top of that 15x rather than at the 11x of that. And that's what they're looking to do. Like, where's your customer concentration? All the basics of business. If you're going to sell, have you got a really strong management team? Are they ready to make that transition? Has the business got loads of recurring revenue model? If we buy it tomorrow, could all of our customers walk away and leave? It's that kind of safety level. And if you can fit all of those into it, you can add all those acquisitions in and make some really good acquisitions and embed them into the business correctly. You have a hell of a business to sell. You've got rid of a lot of the shared functionality. You're not going to have 5 acquisitions with 5 VPs of HR, with 5 different CEOs, with 5 different CFOs, with 5 different finance functions. That back office operation is going to get consolidated, and you're going to obviously scale the other elements of the business and hire into those areas, which obviously significantly reduces cost, which obviously drives EBITDA number multiples just on the M&A side. And then it's all about what's an overly common used term of value creation and how they drive value into a business.
That makes total sense to me. So a private equity group has managers and leaders that understand how to do those roll-ups. They go look for competitive businesses or tuck-ins. They kind of build something very, in a lot of cases, very vertical, right? So they can kind of end up becoming sort of a category unto themselves. They get a ton of market share, and then they bundle the whole thing up. And because, like you said, there was a lot of redundancy they could eliminate across multiple HR departments and all that. And okay, now they have this kind of much bigger thing that's kicking out a lot more profit, and they can sell it. And they typically would sell it to another private equity group. And I think you mentioned earlier, a lot of times the bigger numbers come on that second sale. What happens post second sale? Something I've always wondered, and I'm wondering if you can shed some light on it, is when you're running the deal side of one of these private equity groups and you're looking, and maybe you're the second buyer, how do they consider, like, I mean, I need a customer to buy this, right? They don't want to own this thing for 20 or 30 years. They want to find, I guess, probably further improvement, some way to kind of leverage more profit and EBITDA and then sell it to the next person. But at what point, like, how do you keep finding new customers if you keep rolling these things up and leaning them out? And, eventually somebody's, how many times can you do that before you kind of run out of a customer to buy it?
I mean, the ultimate running out of customers to buy it is to float it. So do an IPO.
Oh, okay.
So that's realistically where your potential option is of what you're going to do. Is, are you going to IPO the business? Are you going to float it? There's certain firms, I don't know how much of Warren's business is actually private, but there's other options where you end up selling a proportion of the business and you take it forward from there. But there's loads of different rounds of private equity firms. And there's private equity, it's a bit like, the banking level, or, there's certain banks that we've never heard of that we wouldn't be able to put our money in because they'd want 100 million down as a basic thing. And then there's bank accounts where they don't expect anything, and there's bank accounts where there's $25,000. There's bank accounts where there's $100,000. Whatever. There's whatever the prime. There's the Coots of the world, and do you have £1 million assets for us to look after? Otherwise, we're not interested. So that goes on and on and on. And some of these private equity firms are doing billion-dollar acquisitions. It's not just here's 5 million for, or 5's probably too low, but here's X amount of money for that. There's lots of rounds. And then you also have those options of selling to what they call strategic and corporate businesses. So if GE, as we've used them as a reference, if it's medical devices, maybe Stryker, and that's where they're going to get the big holy hell sale because it's a lot more valuable. So private equity have to consider the fact that we don't really know the ins and outs of this business. We aren't operators operating and running that company. Whereas if Stryker come in, they will pay more because it's more valuable to them, because they can go, we can get rid of all the leadership because we don't need the CEO. Well, this guy's going to run the business anyway as a president of one of our divisions, and this is a new division for us. That's where you're kind of running through from that. And there's always somebody with more money. Ogalark from Russia or whatever that wants to take over the business, or whatever else from there. There's always somebody that will look to acquire a good quality organization. And then there's always the option of floating that business. But, we've seen a lot of reverse floats now, and IPOs now being taken private and taken off the stock market. So that's another element of where's capital going and who's owning what and what's happening. But there's always plenty of people with plenty of money who want to buy good businesses that they can sell in 10 years time.
That's really interesting. So shifting gears a little bit, you started your podcast in 2020. How has both your business on the recruitment side, but also the private equity industry in general, what's sort of been happening the 4 years since COVID? Did it have an impact, and what has happened sort of since? Is it positive, negative, neutral?
All of the above. Our business has done very well since since, COVID was we've grown the business revenue year on year and profitability, which has been very good. Probably in the most part, nobody's interested in the business. They're interested in what's happening with private equity. So we're not big enough to feel the effect of, we're not a Spencer Stewart, an Egon's End, or a Hydra. So we're not going to feel the market wins too much. But certainly if we look at what's happening within private equity, if you look at the M&A deal market over the last year and a half, it's been down significantly. Now, why is it down? The post-COVID boom was a catch-up of everything that hadn't happened during COVID. There was a lot of bullish mentality. There was a lot of capital. People had a lot of money. People were being paid to do nothing. People couldn't spend their money on going out for dinner because we're all locked down or we're all restricted with what we could do. Amazon couldn't get their stuff to us. If we wanted to buy outdoor furniture, there wasn't any. So a lot of consumer businesses have got a lot more inventory and a lot more problems. But without diving into one industry, there was a lot of growth for businesses. And businesses, when their EBITDAs are high, they want to sell. So if you're having a real boom time, great time to sell. If times are tough and inflation's increased, cost of living's gone through the roof, everything's damn more expensive, it's not a good time to sell because every economy runs on its human capital of its people driving its GDP. If all the underlings, which I'm included in that, don't buy things, we don't drive the economy and we don't move things forward. We're on consumer-related industries with it all filters down to people at the end of the day. People have less money, people spend less, businesses struggle, EBITDAs come down, revenue comes down, nobody wants to sell during those periods of time, unless you go and pop, and then that's a whole different market. But, there's private equity firms that will take you out of Chapter 11 or poor liquidity events and whatever else. In essence, the M&A market's down, which means private equity firms are down, which means there's not as much consumer activity, and therefore there's not as much money flowing into private equity. So private equity has got two problems at the moment. One is deal flow, and the second is either it has too much money as a firm or it has too little money as a firm. So they're either sat on too much capital they can't deploy into companies and buy them because companies won't sell, or they haven't been able to fundraise because the people who give them money, which is institutional investors, pension funds and insurance companies, etc., are not putting the money into them at the moment because they haven't got as much market confidence and they're trying to pay down their debt instead of doing everything else. So we had a really good time. It's really tough at the moment for a lot of firms and there's a lot of struggle. Private equity is no different with following the times and everything else. When there's loads of money around, everyone's happy. But when there isn't, nobody's as quite as bullish on things. And, when things are really good, everyone tells them that it's because they're great. When things are really bad, everyone goes, the market's poor. But, there's some phenomenal deals being done. There's some phenomenal growth. There's some incredible investments being done, and there's some private equity firms that are growing like hell, and there's companies that are growing like hell, even during what we regard as the poor market times.
That's a great answer, very and nuanced, and I appreciate that. So, with that in mind, are there any patterns you're seeing right now in the industry that, like, what industries or types of businesses are still sort of going through these deal processes, and which ones have sort of, I don't know if stalled is the right word, but gotten quiet?
We'll start with what's not doing as well. Tech's really taken a hammering. Life sciences is now recovering. There's one thing that will always be there is healthcare, life sciences, etc. businesses, because if you're Jeff Bezos, Elon Musk and everything else, your biggest concern is, it might be Twitter and SpaceX and your next space rocket hitting Mars eventually. But in essence, the only thing that's going to catch you is going to be death. So there'll always be a level of investment in those areas. Consumer market, depending how you define it, consumer products industries struggled significantly because their inventory is incredibly high and their cash is sat in those inventories and they can't shift the products because people aren't buying them. So we're seeing a lot of that pressure at the moment in the consumer industry. The manufacturing industries is one of those kind of just non-cyclical tech areas, and it's fairly stagnant across things. Aerospace and defense is finding it hard at the moment because Boeing keep making aircraft that shouldn't fly, so that's stalled supply chains. But again, also the aerospace and defense industry doing bloody well because of the war in Ukraine and Russia, and everyone else jumping on board and now starting to think about how they can get involved. So, Lockheed Martin, all the big boys all drive the consumer level. So, world economics and world changes. Markets are doing incredibly. There's a lot of interest at the moment is services businesses. If we've come now from lawn care, HVAC services businesses are getting acquired. There's huge roll-up deals getting played in that. There's lots of private equity firms now seeing business services as a big area for them. Recurring revenue models, people tied into long-term contracts. You may want to drop your lawn care business, but bugger, I signed up for a 2-year contract. I'll stay with it. And then by that time, you've made your money back again and you're all right. So you're like, I'm not cutting my own lawn. I'm not doing my own hedge. I mean, have a go at your own gas and electricity and plumbing and everything else. But Christ, I'd end up dead. These kind of, boiler servicing and recurring revenue models, similar to what the tech industry went through, a lot of the private equity industry seen that as valuations being higher on businesses that have that, rather than what do you do
do, I make something, we sell that to somebody, and we wait for them to come back and buy it again when it breaks or it doesn't do something. The automotive industry is a good indicator of that. Most of the automotive companies, and this was learned from Elon Musk from a podcast, make no money on the car sales. They make all their money on the parts, on the breakdown of the car, on the servicing and everything else. The actual car's a loss leader. Now, Tesla's one of the rare ones that actually makes money on the vehicles, so Elon says. That service level model is what's enticing a lot of businesses, and those businesses are getting the growth areas. There's pockets and bits and pieces, and I know really phenomenal businesses have scaled really quickly in healthcare. I know consumer businesses that have grown incredibly fast, but as a general industry, if you're driving a service-led business, there's a significant interest in those types of companies right now.
And I assume that would be, so disclosure, my dad's business I mentioned earlier was an HVAC business, and it was part of a roll-up. And so I think those things also probably, they lend themselves well to that roll-up model, because if you have a model that's working from marketing and sales and all these, back office type stuff, and maybe you're in 4 or 5 different markets, like I'm in California, and the company that he sold to, they had market share in a bunch of other markets. They didn't in the market he was in. So this gave them sort of entree into a new geographic area, and they just applied all the systems they had already developed elsewhere. And boom, it made an immediate impact. So it was kind of stunning, actually, to see how quickly that actually worked. So it's interesting. One thing I wanted to ask you is it seems like, there's all these different sort of layers within private equity, where you have some that are on the banking side and the deal side, and the people that are out selling or, going through books and trying to figure out what businesses to acquire. But one of the things I wanted to ask you about, and especially since you work on the recruiting side as well, is something I've noticed, and I hope you can kind of first explain this model and then explain what you look for. Is in many cases, even with our own clients, we'll often work with a founder-owned company. After 20 or 30 years, the founder wants to retire, exit, maybe their kids aren't interested, whatever. They sell, the private equity group acquires them, maybe they're part of a roll-up, maybe they're not. And then they'll typically bring in a CEO that's almost like a dedicated sort of portfolio leader, like a CEO that they bring in that's almost like a freelancer that they sort of bring in for a couple of years to sort of turn, not a freelancer is not the right word, but they'll bring in someone that's yeah, exactly. Like to come in, and in a lot of these cases, what I've seemed to notice is these guys, maybe at some point in their career, they have usually like an MBA, and they usually were a more kind of private enterprise type CEO at some point, got some success under their belt, and then they've made this transition where there's a lot of these guys that are sort of repeat, sort of interim CEOs, where they'll bring them in to turn a company around. They spend a couple of years there, they make some structural change, they tune things up, they crank up that EBITDA number, and then they sort of typically, sometimes they stay through the exit, sometimes they don't, and then they sort of move on to the next company, and they're almost like fixers. How does that all work, and how do you look for people like that? And is that a goal for these guys? Is there because a typical CEO wants to come in and they're like building a house, right? And they want to live in the house that they're helping to build, and that they're part of that neighborhood and they're part of that community. And this is sort of a different type of CEO. So I'm curious if you can explain, I guess, first of all, what is that role, and then how do you recruit for it? Because that seems like a pretty special skill set.
Yeah, so it comes back to my earlier point around the best executives in the world, in my opinion, operate in this industry. There's a few cross models there with regards to what we see. So with regards to what we call as distressed or turnaround businesses, there's 2 different phases that business needs to go through to get sorted. And it's a pretty rare beast for an executive to have both turnaround and then growth focus. I've not met a guy that hasn't told me they're good at that yet, but I've only met very few that are actually truly have got the track record that drive that. So if it's a distressed turnaround business, what the private equity firms sometimes will do is they'll bring an executive in to turn that model around, turn the ship around, right the ship, and then they'll bring in another executive to then come and take it forward. The executives are compensated of a proportion of equity within the business. We won't get into the models around how it sits, because there's lots of different ones, but in essence, it's equity. Whether it's real equity or not, it doesn't matter. But they will have a percentage of the organization. And when that business exits, everyone will get paid their bits, and the private equity executives, I've known guys that have got 200, 500K, and I know guys that have got 10, 15, 20 million. What they're looking for is that liquidity event, and their liquidity event on exit. So we move away from the interim, we go away to the growth person. They'll come in day one and they'll look to take that business to the 100 million, and then they'll get an liquidity on the event on that. Now, they may want to go again, but the private equity firm may not want them to. So the new acquirer, if it's gone to private equity, may say, we want our own team, we're going to bring our own executive in, because you've never run a business at 100 million and taken it to 500 million, and you've never taken it to $1 billion. And that's what we want to do. That's what we're going to do. we need a new CEO. So they will come to someone like us and say, we want a CEO, 100 million, 500 million, take the business from 100 to 500, and then drive an exit process. And that is in essence what these guys are looking for. And they look for proven market operators who've been there, done that, worn the t-shirt to come and do that for them. And that's chief exec, CFO, COO, anyone in the C-suite is at risk every turn of a liquidity event that they will possibly lose their position.
Okay. So, and like you said, these are obviously very smart operators that can come in and do that and then jump to the next thing. And very interesting. What advice would you give someone who's looking to start a career in private equity? And is that something like, as a recruiter, do people come to you and say, I want to be involved in this industry? Or are you approaching people that maybe have other skills that you see as transferable? What would you say to those types of people?
So I get approached a lot. And it's probably for people outside the industry, let's say you're a chief exec or you're a divisional president of a business and you want to do an exit. You want to exit into private equity or you want to get into it. It's probably one of the most common questions that I get. How do I get into private equity? It's the age-old thing of how do you get experience without experience? You need to be damn good at what you do. And private equity will consider you, but you have to be at the top of your game. Or you're going to go into a business that's probably pretty poor and that none of the good players will play in. Work in a private equity-backed business would be a good start. And then everyone's like, well, how do I work in a private equity-backed business if I'm not working in a private equity-backed business? Don't start trying to get into private equity when you are the CEO. Start trying to get into private equity if you're employed as early as you possibly can. I know loads of people that work in private equity-backed businesses that are gunning and going forward. There's a podcast I did actually where a guy went from shipping clerk to chief executive and sold a business for, his name's Ted Clark, and sold a business for 1.4 billion.
Wow.
Enterprise value, which is mental. So my advice is to be involved in that type of fast growth business, because if you're in a business that's grown from 5 million to 7 million in 15 years, it is nothing like the ride of being in a business from 10 million to 100 million in 5. Everything changes every quarter. And I don't mean, oh, well, all our chairs have moved. Yeah, your offices might move, but the whole growth phase of a business, you can't do what you did at 1 million to go to 2. You can't do what you did at 2 million to get to 10. You've got to change and grow and develop that business. And those changes leave patterns, those changes leave breadcrumbs, and you have to follow those. But go and work in those organizations. Please. I mean, look, if you're an absolute superstar and you're working for a division of a business and you've taken it from 10 million to 100 million, 100 million to 500 million, yes, you can get into private equity. But that's quite rare. Get into private equity-backed business earlier in your career as you possibly can and enjoy the ride and enjoy the wave and be prepared for change, be prepared to do different jobs, be prepared to work like a dog and run hard. And that's where I would advise anybody to get into. Now, look, doesn't mean you can't get into it if you're doing X, Y, and Z. You just have to be at the very top of your game. If you're at the top, you'll get opportunities, and private equity will say, we'll give you a shot.
Really smart. That's really, really great advice. Thank you. One thing I wanted to ask is, as we kind of start to wind this conversation up, is what, in your experience in having worked with this industry for so long, do you think that there is a conversation happening at these private equity groups where are they trying to balance the need for short-term growth with like long-term growth and sustainability? Or is, if they're looking at a 5 to 7 year sort of exit, are they trying to build something that's going to last 20 years? Or are they mostly focused on sort of getting that EBITDA multiple so they can make their exit and move on?
I think that's a really interesting question. And as somebody that supplies into the industry, my answer to that question should be, I think they're really focused on long-term growth. But my actual answer would be, I don't think enough of them are. I think a lot of them are just focused on the exit. I think that's harsh, but also fair to a certain extent. But it depends on the private equity firm. I know people that hate private equity, and I've had emails from people saying I'd never work in it. And I'm like, fine. I know people that really hate recruiters. I know people that really hate estate agents. I know people that really hate salespeople. And I'm like, you don't hate any of them. You just hate the bad ones. And there may be more bad ones than good ones in your eyes, but that's not the case really. 80% of them are pretty good, right? And 20% of them are dreadful. You've just come across more than 20% of them because you haven't had enough conversations with people. The people that interrupt our day trying to sell us stuff on the street, and you're like, oh God, I hate salespeople. Whereas if you're actually, trying to broker a deal to sell a business and you're like, Jesus Christ, this person is incredible. Okay. Or you've done X, Y, and Z and they're the top of their industry. Top of their industry salespeople, no disrespect, in the most part are not selling on the street. So the people that we come in, they're not coming to sell us our windows and doors because they're earning hundreds of thousands, millions of pounds selling something better. Would you rather sell windows and doors or a plane? I'd rather sell a plane, right? So the concept around private equity on that basis, they are too focused on the 5-year. And I understand that because that's their model. It's a bit like when you sell a house. Do you make that house as good as you possibly could? Do you make sure that there isn't that bit of damp in the wall? Do you make sure that there isn't this? Or do you just plaster over it and say it's going to be fine? Do you paint over those cracks? Do you put polyfiller in the areas where there's a bit of shuffle with the building? Or do you highlight and tell everybody it? No, right? And that's life and that's business and people have to do their right due diligence. But fundamentally, do they create very strong foundations of businesses? Yes. Do private equity take these companies under? In some instances, yes. In 80-90% of these businesses, no. These businesses make stupid decisions themselves. Like KKR got a bad rap for Toys R Us. But if you look at Toys R Us and the decisions they made, they rejected the internet. They thought it was a fad. Their board member note said, we don't think people like to come to our stores and they like to buy our products. No, the dad likes to sit in his pants doing nothing but buying toys for his kids where he doesn't have to go to shop and they have to kick off and want everything. And Amazon can deliver it tomorrow and he doesn't have to move his car out the drive. Modern world of living. Blockbuster was the same with Netflix. Blockbuster said, we've done a survey and our people who shop at our place like to come in. They like the opportunity of buying popcorn. They like the opportunity of reading the back of the DVD and immersing themselves in it. And they like the opportunity they may bump into their neighbor. Now, they may be right with that, but I don't care about any of that, and Blockbuster isn't here. I don't care to bump into my neighbor. I don't care to buy popcorn. I can buy that from a shop, and I'm certainly not interested in reading the back of a DVD. I'm more interested in the face. What does it look like? Is it good? And I like to sit in my pants in front of my TV, pressing a button, deciding what DVD, and I certainly don't want to pay late fees more than the actual DVD's worth, right? So they didn't listen to their market. I don't know if Blockbuster were, but Toys R Us were definitely private equity backed. So those businesses made the wrong decision. Those executives made the wrong decision. The private equity firm invested in those executives and put them into positions. So, yep, they are accountable. But at the end of the day, the private equity guys don't run the companies. The portfolio executives do. They prepare their businesses as well as they need to do to get the return that they need to have. And that depends on the executives they appoint and everything else, which obviously I would say use a recruiter. I don't care who you use, get the best possible person to run your business. That's always the case. Ever the answer of everything. 95% of all business problems are talent problems in disguise.
For every business, not just for private equity businesses, for every business. Get the best people you can.
Every business, everywhere. Get the right person in your business. You will do well.
Love it. Last question for you, Alex, and this has been so enlightening, so thank you. Thinking back on your own career, your own business, and your experience in this industry, what was the biggest mistake you made, and what did you learn from it?
First thing that comes to mind, ironically, is people. But I'm not going to answer that because that's the big cliche of recruiters. We lower our standards. We accept the unacceptable. It's okay. It's just them. That's who they are. Nah, that's all right. You know, the person's doing X, Y, and Z. Do you know what? It's okay. It's just this. I was at a big meetup of recruitment business owners, and this guy was talking, and everyone, it's this big round table type event. And this guy went, it's really annoying how you scale your business and you just have to accept that everything's going to get worse. And I was like, nobody's grown a business on the back of that. Nobody's ever wanted their service to get worse. No one's ever wanted their quality to be worse. That's what I think is the biggest mistake. And I'll link that to a story. Unfortunately, it's going to come down to people. But again, 95% of all business problems are people problems in disguise. We hired the wrong people into our organization. They eroded our culture. They caused lots of problems and infighting and issues, the kind of stuff you'd expect at a school, which happens in every business everywhere. We didn't get rid of them quick enough. And they stayed. They hacked me off. They hacked other people in the business off. Fortunately, we didn't lose anybody on it because we're not big enough for that. But it caused drama and issues and problems inside the business. And I lowered our standards to be able to say, it's okay, we'll get through this, we'll change them, we'll make the development. We didn't have a good enough hiring policy and we didn't have a good enough development policy for our people. And we lowered our standards. So my message to everybody is don't accept lower standards because it kills your business. Don't accept the wrong people into your organization because it kills your business. Work on retaining those standards, holding people to account and having those difficult conversations. If we'd have done that, we'd be further on than we are now.
Great answer. Super insightful. Thank you. Alex, I've really enjoyed this conversation. Thank you for joining us. Where can people find more about you, your show, and your business?
Yeah, I appreciate that. So best place, I'm on LinkedIn, very active. What recruiter isn't? Alex Rawlings. There is an Alex Rawlings, if you Google him, who is a polyglot which I understand is someone who's got a ridiculous amount of languages. Unfortunately, that is not me. I'm the Yorkshireman from England who speaks one language of English, classic British type mentality. But yeah, Alex Rawlings, Raw Selection. Rawlings and Raw Selection will give you an indication why I poorly named my business after what sounds like a pet food company. Look for us on LinkedIn. You'll see me on there with Raw Selection. We also have the podcast, which is Private Equity Podcast, which is, I believe pretty good and bring some value. We're not there to sell. We're just there to bring value to the industry. And yeah, I was happy to connect with people, have conversations and discussions and help anyone in your audience.
Excellent. Thank you very much. And I highly recommend your show. I would recommend our listeners to check out the Private Equity Podcast. That is the end of today's episode of Only the Strong Survive. Let me know what you think by rating the podcast on the platform you're listening to. We also post these videos on YouTube, so be sure to like and subscribe there at OTSS Podcast. Likes, comments, and follows really help the show. I want to thank you again, Alex, for coming on, and I hope everyone has a great rest of their day. Thanks, everybody.